The program examines the various methods investors use to access real estate and commodity investments within alternative asset portfolios. Real estate and commodities provide diversification benefits because their return patterns often differ from traditional equity and fixed income assets. Investors may access these markets through listed securities, private structures, pooled investment vehicles, derivatives, or direct ownership arrangements. The program emphasizes that investment structures differ significantly in liquidity, transparency, leverage, taxation, and operational complexity. Understanding the characteristics of these access methods is essential because investment performance depends not only on underlying asset appreciation, but also on financing arrangements, market conditions, and the structure used to gain exposure. These factors strongly influence risk-adjusted returns and portfolio efficiency. Unlisted real estate funds are private investment vehicles that pool investor capital to acquire, manage, and dispose of real estate assets. These funds are generally structured as closed-end partnerships and are categorized according to investment style, including core, core plus, value-added, and opportunistic strategies. Core funds typically emphasize stable income-producing properties with low leverage, while opportunistic funds pursue higher returns through development projects, distressed assets, or aggressive leverage. Investors in unlisted real estate funds benefit from professional management, diversification, and access to institutional quality properties. However, these funds also involve significant illiquidity, long investment horizons, valuation uncertainty, and capital commitment obligations. Performance depends heavily on property selection, financing strategy, market timing, and active asset management expertise. The return drivers of private equity real estate funds are influenced by both property-level performance and broader economic conditions. Key components of return include rental income, capital appreciation, leverage effects, and operational improvements implemented by managers. Economic growth, interest rates, demographic trends, and supply-demand imbalances strongly affect real estate valuations and occupancy rates. Leverage can magnify returns, but also increases financial risk during market downturns. Opportunistic and value-added funds often seek additional returns through redevelopment, repositioning, or distressed acquisitions. The program emphasizes that private real estate performance is also affected by illiquidity premiums, transaction costs, and manager skill. Successful managers combine financial expertise with operational capabilities and local market knowledge to generate superior risk-adjusted returns. Listed real estate funds provide investors with liquid exposure to real estate markets through publicly traded securities, such as real estate investment trusts, REITs. REITs own, operate, or finance income-producing properties and distribute most taxable income to shareholders as dividends. Listed real estate vehicles offer advantages including daily liquidity, pricing transparency, lower investment minimums, and ease of portfolio implementation. However, listed real estate securities often exhibit greater short-term correlation with equity markets than private real estate investments because they trade continuously on public exchanges. Market sentiment, interest rate expectations, and equity volatility can therefore significantly influence REIT prices. Despite these characteristics, listed real estate remains an important component of diversified alternative investment portfolios because of its income generation and inflation hedging properties. Commodity investments provide exposure to physical goods such as energy products, metals, and agricultural commodities. Investors typically access commodities through futures contracts, exchange-traded products, swaps, commodity-linked notes, or commodity-focused companies rather than through direct ownership of physical assets. Commodity returns are influenced by inflation, global economic growth, geopolitical events, weather conditions, and supply-demand dynamics. Commodity trade and production financing also play an important role in market functioning, as producers, merchants, and financial intermediaries use financing arrangements to support inventory management and operational activities. The program highlights that commodities often serve as inflation hedges and portfolio diversifiers because their performance may improve during periods when traditional financial assets experience stress or declining real returns. Managing commodity exposures requires careful consideration of leverage, derivatives, and market structure risks. Many commodity investment strategies rely heavily on futures contracts, which introduce rollover risk, margin requirements, and exposure to contango or backwardation in futures markets. Leveraged commodity products can amplify gains, but also significantly increase volatility and downside risk. Option-based commodity strategies provide investors with additional flexibility for hedging or generating asymmetric return profiles. Effective commodity exposure management involves balancing diversification objectives, liquidity considerations, risk tolerance, and inflation expectations. The program emphasizes that commodity investments require active monitoring because market conditions can change rapidly due to geopolitical shocks, weather disruptions, production decisions, or shifts in global demand patterns that affect both prices and volatility.